My question is, if you were investing a small sum today, which approach would you use?
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now. You mentioned that 56 to 69 was the best period. Actually, my best period was before that. It was from right after I met Ben Graham in early 1951. But from the end of 1950 through the next 10 years, actually returns averaged about 50% a year. And I think they were 37 points better than the Dow per year, something like that. But I was working with a tiny, tiny, tiny amount of money. And so I would pour through volumes of businesses, and I would find one or two that I could put $10,000 into or $15,000 into that they were ridiculously cheap. And obviously, as the money increased, the universe of possible ideas started shrinking dramatically. The times were also better for doing it at that time. But I think if you're working with a small amount of money, with exactly the same background that Charlie and I have, and same ideas, same whatever ability we have, I think you can make very significant sums. But as soon as you start getting the money up into the millions, many millions, the curve on expectable results falls off just dramatically. But that's the nature of it. When you get up to things you can put millions of dollars into, you've got a lot of competition looking at that, and they're not looking as I did when I started. When I started, I went through the pages of the manuals page by page. I mean, I probably went through 20,000 pages in the Moody's Industrial, Transportation, Banks, and Finance manuals. And I did it twice. And I actually, looked at every business. I didn't look very hard at some. Well, that's not a practical way to invest tens or hundreds of millions of dollars. So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. There's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money. Charlie?
Well, yeah, I think that's right. A brilliant man who can't get any money from other people and is working with a very small sum probably should work in very obscure stocks, searching out unusual, mispriced opportunities. But, that's such a small world. It may be a way for one person to come up, but it's a long slog.
Yeah, most smart people, unfortunately, in Wall Street figure that they can make a lot more money, a lot easier, just by one way or another getting an override on other people's money or delivering services in some way that people. And the monetization of hope and greed, is a way to make a huge amount of money. And right now it's just take hedge funds. I mean, I've had calls from a couple of friends in the last month that don't know anything about investing money. They've been unsuccessful and everything else. And, one of them called me the other day and said, well, I'm forming a small hedge fund, $125 million he was talking about. Like the thought that since it was only $125 million, maybe we ought to put in $10 million or something of the sort. I mean, if you looked at this fellow's Schedule D on his 1040 for the last 20 years, you'd think he ought to be mowing lawns. But he may get his $125 million. I mean, and it's just astounding to me how willing people are during a bull market just to toss money around because they think it's easy. And of course that's what they felt about internet stocks a few years ago. They'll think about something else next year too. But the biggest money made, in Wall Street in recent years has not been made by great performance, but it's been made by great promotion, basically. Charlie, do you have anything?
Well, I would state it even more strongly. I think the current scene is obscene. I think there's too much mania. There's too much chasing after easy money. There's too much misleading sales material about investments. There's too much on the television emphasizing speculation in stocks.
My question is this. If you were starting out today with $1 million, with a vision of building a business with 20% average growth in value over 40 years. What type of investments and investment strategy would you look to make in the first 5 years?
Well, it's somewhat interesting that we formed the first partnership 50 years ago, 2 days ago, Thursday, May 4th, 1956, which was 105,000. That's my sister clapping. She was in the partnership. Charlie and I were starting all over again, and we were in this. Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world, and we would look at a Korea, and Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. You do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire. If we were trying to buy businesses, we'd have a tough time. We would have no reputation, so people would not be coming to us. We'd be too small a player if you're talking about $1 million. So we would not have much success, I don't think, with small amounts buying businesses. Charlie started out, in real estate development because it took very, very little capital. And you could magnify brain power and energy, or I should say brain power and energy could magnify small amounts of capital in a huge way that was not true in securities. My natural inclination was to look at securities and just kind of do it one foot in front of the other over time. But the basic principles wouldn't be different. I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be dreamland. And in the real world, you have to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. So the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership, but he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost.
Number 9.
By the way, that's in the freshman course in economics everywhere in the basic textbook. It just hasn't made its way into modern portfolio theory.
We don't get asked to do book reviews.